Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
So the bond market has already won, in my opinion, against the Fed because they made their play first. Okay, they pushed the Fed to start hiking in July 2022 because the Fed was saying that, look, this is not gonna be forever. This inflation is temporary. They called it transitory, whatever, but that's not important. Important is that it had a reasonable argument because the COVID was artificial shutdown, right? So humankind comes in and says, well, we are panicking and we're gonna stop all the businesses. There was no other reason for economic difficulties to be created. So they forced shutdown. But it's even worse than that because they didn't shut down everything. Okay, many industries continued to operate. So people who worked in those industries did not really have a difference. Actually, they have more money. They had more money because government initially sent some assistance, remember, to everybody, and then the rates were reduced to zero, so the stock market recovered very quickly and a lot of people made a lot of money. There was nothing to do, so people saved money that they usually go out and spend for entertainment or vacations. And so for those people, things actually got financially better. But it's only for some people. Portion of the population lost their jobs. The government assistance for many of them was not making up the money that they lost through losing the job, right? A lot of the so-called postponed loan payments and other stuff and rents were temporary, so that will start hitting those people, or some are already hit hard after the COVID. So there is a portion of population that is depressed, okay, and for them the inflation is painful. But for the other people, they may even barely notice this inflation because nothing really happened. Yeah, the point is also inflation is always there. The Fed did not care about the inflation after the financial crisis. Remember the 2010 to 2020, 10 years, I remember prices for food were very high. Rents were increasing 25% annually. Well, not annually, but probably in 4 years, I remember 25% easy was increase in rent. The house prices were going up about 15 to 20% annually, depends on the area. So, but the wages were not moving after the financial crisis. Some people even getting lower pay than the previous person when they were coming in to fill positions. The wages were kind of depressed and stagnant. So for Fed, that looked good on paper, so they were not really caring about the inflation, right? Plus they blindfolded themselves by creating the core inflation. They said, food and gas now not really visible to us. And so they were happy. Nothing was happening in terms of rates and worry and all of that. But then the COVID hit, and we had created this artificial imbalance. Part of it was low rates, like zero basically, right? Some jobs disappeared temporarily, and companies were stopping producing, and other continued, like nothing was really going on. So for those companies, the problems were beginning to rise, because some raw materials and some parts and some other things become more difficult to find. It was a long time. It was like over a year that certain companies didn't produce anything. And the prices started to rise, and and difficulties were beginning to build up for companies that were open and producing. And then they said, oh, okay, now we're reopening. But reopening was not really, for everybody, right? Some people reopened and some people didn't. But people who reopened, they needed their workers back. But another problem that was created, a lot of people during COVID started to doing their own gig work. And they liked it because it was working. They were making money, and they were basically getting some continuous government assistance plus making money. So they just stayed in that. It may or may not last into the future, but it will take some time for them to make that decision. So meanwhile, companies that were coming out of shutdown and so-called reopening, they needed to refill positions, right? And so they were fighting at the same time for a lot fewer people, right? But then other companies that were not closed during shutdown, some products that they were producing were in a little bit less demand, but some other products were in higher demand. But because it was still plus or minus, they kind of managed. But now that the shutdown was closing and reopening began, they knew they would need additional power to produce more product. Because there will be higher demand coming out of shutdown and the reopening of some medical practices and some other stuff, for example, and some stores and some other things. They will need the additional products, so they started to increase hiring. And so it all happened simultaneously. Like when companies go out and make new product that they will start producing, they need to hire more people for that future state. However, it's not happening across the board, right? It's some companies are not. So it balances out. But when everybody at the same time and everybody needs all the people, it's a shortage, And so we have this labor shortage that is continuing, and it will continue for foreseeable future. And there is nothing Fed can do about that. And he admitted it, like Fed J in November press conference after their meeting. He said that the tools that the Fed has cannot control the availability of labor. There's nothing they can do about that. So he understands it. They admit it. They acknowledge that this is the situation. So now they are going to be hypocritical at this point because they didn't care about inflation between 210 and 220, but the prices were rising. Okay, I was spending a lot more money after financial crisis over the years on food and gasoline and the rents and the housings and all that. And of course, the healthcare was always rising. So that inflation always there. It's just everything was kind of balanced out over decades, and the Fed came up with these formulas where they could comfortably live with all that because things were stable more or less. But now we created instability by shutdowns and disbalances, and that affected all those calculations artificially. And what we deal with is now the situation where the bond traders who loved all this stuff, they decided, we're going to bet against the Fed that they will have to raise, because they saw that the inflation starts to picking up, but there are natural reasons for it, but reasons that were temporary due to unbalanced shutdowns and imbalance economic situation that followed that COVID, that would be settled over time, because all imbalances can be self-corrected if they're not fundamental. These are temporary things. You create energy, and then energy to dissipates once you let it go. And like a wave, it starts to stabilize. But it needs some time, okay? It's not a big deal. We always had inflation, but in this case, right now, the people got higher pay. The wage raise was across the board. So people had actually more money to deal with inflation. So It's only a problem on the Fed paper, okay? But it's not a problem in real life. Like, people have less of a problem with this inflation than inflation post-financial crisis, for example. And in this situation, post-COVID and start of reopening, the bond market made a bet, okay? And then they sold off and shorted the bonds to create high yield that screwed the stock market. And the Fed first wouldn't budge, but then the Fed got overpowered emotionally, even though rationally Fed understood I should just wait. They didn't want to touch anything. But we don't live in a rational world, we live in an emotional world, especially when people with a lot of money, like bond traders and institutions like that, can create emotional situation by publicizing that the Fed is not doing its job, that the regular Joe will be destroyed by inflation and all that inflation is too high. And they were screaming, remember all of that, and their mouthpieces were screaming, and then they forced all together with the media, the Fed, to pivot and like go to panic mode, raising the rates in 75% basically, starting summer 2022. Now, the Fed is bureaucratic entity, so once they go into certain mode, they are under influence of the dynamic of Fed being Fed, and so now they have to continue doing what they're doing, because otherwise they will be, bond market argument has already the upper hand. So they forced the Fed to do it. Now they're gonna play it until the end. 200% bond market will win this one, because they already won by doing the first move, and then the forcing Fed to do what they want them to do. So now the bond market is baiting that, oh, look, inflation is coming down. But inflation is coming down not because the Fed raised the rates. Inflation is coming down because it would come down anyway, because it was an artificial disbalance created by people actions, not by economy or anything else. Physical, rational decision that was probably irrational and emotional, but it was still human-made decision to stop doing certain things, creating imbalance. So now it will be corrected over time, and we can see it. Now, if the Fed was actually causing this inflation to come down, we would see, things that normally banks stop loaning, and all of that financial activity would start to slow down. The companies would not be able to get the money but it's not happening. All of that is continuing, and the companies have a lot of money still from the other deals and businesses that they did during COVID. So that's also part of this balance. And they can hold on to their employees because they know how hard it is. It was actually very hard even prior to COVID. Things were beginning, because the economy was good, economy was growing, and it was already getting kind of difficult to find people, especially like specialists. But then it became even worse, after the 2021 starting, and then the reopening and all that. It's really hard, and they have to pay a lot of money, and it was across the board, and a lot of extra money to hire people, bonuses and higher pays and all of that, and the different other things that they were giving to people now, especially the more specialist type you need. And so they know it's going to be even worse if they let these people go now, because this situation will pass. This will pass, and the Fed will start cutting again, because they never keep it forever or even long time. Historically, they always raise it and then they have to cut it. This situation, whatever will force them, that doesn't matter. It's not important what specifically will force them to cut it first. Basically right now, in my eyes, the argument is between the labor market will start to shrink, or some kind of financial crisis will endure because of the high rates. that they will try to hold on to right now, because the Fed is in this inertia, basically, this bureaucratic inertia. They have to hold face and hold the rates. But the labor market is not going to budge because it has no place to budge. There's not enough people. Okay? People from gig economy are not going to come back all right away. Some maybe will, but it's going to take years. There is no other people to come from. Companies don't want to fire a lot of people because, especially specialists, because it's going to be even more expensive to hire them back later, and they will need them anyway, and they have the money right now. So, and the banks continue to loan money, and so there is no problem. The labor market generally cannot lose in the time span that the Fed has. Financial systems are more fragile, okay, and they will budge first, and then the Fed will have to react and cut rates, and the bond traders will win again because they already made their play number 2. They said, hey, they will cut it, and we're buying, so they want money on selling the bonds first. Now they're gonna make money on buying the cheap bonds first. They made their money. They're happy. They were screaming it was high inflation, poor regular Joe. Now they're screaming the inflation is gone, poor regular Joe again, that is gonna get screwed on jobs, But they don't care. They don't care about regular Joe. Neither does the Fed, actually, but based on my observation. But one way or the other, what we will have, Fed will cut the rates for one reason or the other, sooner than later, and the bond market will be happy and make some other play later, and the labor market probably will not be affected much. But what will always be affected are the people who are in a worse situation in life, people who were losing jobs in COVID, who didn't start their own businesses on the side or gig, and are trying to come back to workforce, are trying to get paid a little bit extra this time. So all of that's going to be decapitated by the Fed trying to raise rates and destroy those wage hikes. Although I think their only option for the Fed is to wait for some government statistical tweaking to show that the wages are coming down, and they can start safely lowering their rates, because basically the situation is resolved. And maybe that's the way out for the Fed, and to save face, because one way or the other they lost the trade to the bond market. And that's about it.